Hello, everyone. Let's get ready for our Chapter 3 video lecture. You ready? Let's go. So, Chapter 3 focuses on how to analyze different types of business transactions. So, first, we must determine and analyze what are business transactions. These are any economic events that require recording a company's financial statements. To further explain that, these are any type of transaction that would change a firm's economic resources, whether it is buying a product, selling inventory, paying taxes, insuring, renting out office space, providing a service. Any of those events that would change a firm's economic resources are referred to as a business transaction. In accounting, our job is to record the impact of these transactions to what's known as the accounting equation that we'll look at in a few minutes. And with the accounting equation, it has section known as asset section, liability section, and stockholders equity. Your job as the accountant is to show what impact the business transaction has on the company's assets, liabilities, or stockholders' equity. Dual effect on the accounting equation. What does that mean? That means that when recording transaction to the accounting equation, the accounting equation must always be in balance. So to further explain that, let's go through some actual transactions. So here we have what's known as the basic accounting equation that says assets equal liabilities plus stockholders' equity. By dual effect, what we mean is that this accounting equation must always be in balance. The total assets of a business must always equal their liabilities plus their stockholders' equity. So if we have an increase in assets, there will also be an increase either in liabilities or in stockholders' equity because there has to be a reason why the assets increase. Do we have more debt because we borrow money? Or do we have more assets because we issue shares of stock? It was earned by providing a service, selling a product. So you would never ever have an increase in assets alone without it impacting either the liability section or the stockholders equity section of the accounting equation. To break it down either further, when you think about stockholders equity, it has two main components, common stock and retained earning. So when a company sells shares of their stock to the stockholder, it is shown in the common stock section of the accounting equation. When a company has a profit based upon revenues exceeding the amount of expenses and dividends paid out, it goes into a section known as retained earnings. As we discussed before, the word retain means to keep. What are we keeping? We're keeping our earnings. So these are the sections that will determine whether we have an increase or a decrease in retained earnings, revenues, expenses, and dividends. Let's get into some actual transactions and practice record them on the accounting equation. So you ready? Let's go. For our first event, it says on October 1st, cash of 10,000 is invested into Sierra Corporation by investors in exchange for $10,000 of common stock. This is an example of a business transaction. Your job is to analyze this transaction. You want to first focus on which accounts are involved in this transaction. How were the accounts impacted, meaning did they increase or decrease? And the accounts fall up under which section of the account equation? Did it impact asset accounts, liability accounts, or stockholders' equity? So it says that we received cash in the amount of $10,000. So of course, cash is an asset and it's increasing. So the cash account increased by $10,000. The company issued common stock. Common stock falls up under stockholders' equity. Therefore, the equity side of the account equation also increased by $10,000. Notice that this transaction, it balances. The assets equal liabilities plus our stockholders' equity. You want more? All right. Next, on October 1st, the company borrowed $5,000 from the bank, signing a 3-month, 12% notes payable amount of $5,000. So once again, your job is to analyze this transaction. You determine which accounts are involved in the transaction, if the accounts are increasing or decreasing, and the accounts fall up under which category. So we borrow money, therefore cash increased by $5,000. But because we borrowed the money, our liabilities, more specifically notes payable, also increased by $5,000. So the transaction itself is in balance, but the account equation is also in balance. We now have total assets for $15,000, but we have debt of $5,000 and equity of $10,000. Therefore, the account equation is still in balance. You want some more? Got it. On October the 2nd, we purchased equipment by paying $5,000 in cash. So I give you a second to think about this. We took cash and we bought equipment with a cost of $5,000. For this transaction, it's going to impact two asset accounts, cash and equipment. The cash account decreased by $5,000 and the equipment account increased by $5,000. Notice that it did not impact the right-hand side of the account equation. We exchanged one asset, cash, for another asset being equipment. So for each transaction, it doesn't have to necessarily impact both sides of the account equation if you have an offset, because in this case, again, we exchange cash for equipment. Therefore, our total asset amounts remain the same. Next transaction, we receive a cash advance from a client in the amount of $1,200. So this is saying that a client paid us in advance before we provide them with an actual service. The amount received totaled $1,200. Therefore, your cash account increased by $12, but now we have a liability, which is called unearned service revenue. It's a liability because we received cash before providing the actual service. We now have an obligation to perform a service as a client at some point in time in the future. That obligation requires this as being a liability. But again, notice that for every transaction, there are at least two accounts involved in each transaction. And once you record each transaction, the account equation must be in balance. Now, there's some other transaction in the textbook and the PowerPoint presentation. I did not go through all of those. You can go through those transactions. But once you record all of your transactions, you'll get a total for each of your accounts. Total for cash, total for supplies, prepaid insurance, etc. Once you're done, you have to make sure that the accounting equation is in balance, meaning that your total assets equal your total liabilities plus your stockholders' equity. If your accounting equation is not in balance, you must figure out what is causing the account equation to be out of balance. Did I transpose a number? Did I record an amount on the incorrect category? Did I add up the totals incorrectly? But there's never a time when the account equation should be out of balance. As an accountant, you are a problem solver, and your job is to make sure the account equation is in balance. If it's not in balance, you must go through the transactions to figure out what's caused you to be out of balance. Okay? So that's going to end the first lecture on chapter 3. The next presentation will focus on how to record the same transactions into a form known as the general journal and learn about what's called the rules of debits and credits.